Hey everyone, this is Mortgage Mario. So I want to explain the FHA 100-mile rule and what that is. I get asked this question a lot, and it's kind of complicated to the everyday home buyer that's not a mortgage professional. So essentially, well, before you watch this video, remember to click that like and subscribe button if you like this educational content. But essentially, the FHA 100-mile rule is going to apply in two different scenarios. So scenario one is if you're trying to use rental income. You can only use an FHA loan if you're buying as a primary. So you can't ever use an FHA to buy as an investment. So this is the only scenario you can use this as. So if you're trying to move out of your current property and acquire an FHA loan as a primary, and you notice that your loan officer is running numbers, or even if you're running numbers, and it doesn't appear that your debt to income ratio is going to allow you to qualify to have two properties, maybe you're trying to, again, acquire investment properties or things like that, and trying to get in the investment game. An FHA loan seems to have the best terms. If you're trying to use rental income from the property you're moving out, the primary residence that you're converting into an investment, whether it is a conventional USDA loan, whether the loan product, even if it's not an FHA loan on that current mortgage, FHA will prohibit you from using that investment income. So that could create an issue if you're trying to buy another house. Now you have two mortgage expenses, housing expense ratios on your debt to income ratio. That could prevent you from acquiring another FHA loan. FHA does that just knowing that, hey, we're using this. You're getting very forgiving terms, very lenient on things like credit and debt to income ratio and things of that nature. And that's where they don't really have much remorse. If you've got a second property less than 100 miles away, that's kind of their rationale behind that rule, is that this person's really more doing this to investment. They're not doing this to really acquire the American dream for homeownership or anything of that nature. So that's why they won't require that. You could still get an FHA loan. You just, assuming that property was an FHA, you could still get another one less than 100 miles. You just would have to count that debt obligation. So that's essentially number one. If you are 100 miles away from that property, then essentially we can use the rental income, and then we would have to make sure that we would actually have to get a 1007, that's a special rental analysis on that property, first of all, to basically justify the lease agreement. If that property is recently being leased out, it just recently been converted, it's not going to be on your tax returns. We would see that on your Schedule E on your tax returns. So if it's not on your tax returns, then essentially we would have to get at least a 1-year lease agreement in place to get that approved in underwriting. And we would have to establish 25% equity in that property, and that primary residence being converted into an investment. If there's less than 25% equity in that property, then you would not get approved in underwriting. So they're very conservative from that fashion. If it was the other way around and we're going to buy any conventional loan, that when the equity in the primary property being converted into a rental would not even be scrutinized. And please take note, that doesn't matter. I get asked this a lot. We're like, hey, that property being converted into an investment property, that primary being converted into investment, isn't an FHA loan. So it doesn't matter. All those rules don't apply. And that's a misconception. So it's, as long as you're buying as a primary with an FHA, it doesn't matter what that other residence being converted into investment property, what type of loan it is, even if it's free and clear or anything of that nature. It's just basically trying to use that rental income. So hope that clears that up. And know that we can run a rental analysis on it before you go under contract, but when you go under contract, we would have to order a special appraisal, not only on the primary residence being purchased, we'd have to order a second appraisal on the investment property being rented out, and there would have to be a specific 1007 appraisal. If that essentially doesn't show basically the proper rent schedule, and it doesn't show the proper value in that property, and that doesn't show a 25% equity, that could be a problem. So it's a much stricter when trying, even outside a 100-mile radius, trying to buy another FHA property via FHA. So probably going to want to try to go conventional if possible, if you're trying to convert a rental property into an investment. The second way is like, hey, you own a house already. It's less than 100 miles from the subject property that you're going to buy as a primary with an FHA. And that is serviced by the FHA. So even if you're not using rental income on that property, it's less than 100 miles away, FHA will not allow you to get two FHA loans. As a good rule of thumb, you should never get two FHA loans. That's typically just not allowed. It's very strict. Again, they're using it to buy as a primary. They're very lenient on the terms, but then FHA's remorse basically, drops off as soon as when they know people are trying to get more than, one loan with this lenient loan product. So even if you're not, again, you couldn't use the rental income, even if you could qualify, FHA wouldn't allow that. And typically they wanted the context, like very specific reasons, like, hey, this person just got a new job. We can see that he started a new job in Georgia. Maybe he's got a house up in North Carolina, and he's relocating from North Carolina to Georgia. And the reason behind that is they're going to allow that is essentially maybe the person can't sell their property yet. So that's just in context that makes sense, right? We're not going to penalize this guy because he's having trouble selling his property in North Carolina. He's moving down as a primary. It seems like he's probably eventually going to sell that property. That's kind of a very contextual situation. Again, the loophole, you'll hear people say, oh, you can get two FHA properties. And there's essentially, loopholes on that. And again, in underwriting, I don't like to pre-approve people off of loopholes or special stipulations and things that are basically going to come down to mortgage law gray area, depending on how it's scrutinized. But there are definitely ways around this. I've gotten people through underwriting around this, but you got to make sure it's structured. You have a strong explanation for this, and you want to swing it by an underwriter as well, and just make sure you have a very well confident laid out explanation. One situation I've seen is where they actually, maybe it's a divorce. So maybe one spouse in the divorce decree is keeping the property and is going to live there as a primary residence. On the mortgage, a divorce decree is not going to eliminate mortgage debt obligation off the spouse's credit report. So maybe they bought it together. Maybe it's on both their credit reports. That's going to keep, no matter what they're going to divorce decree, even if you send a divorce decree to a mortgage loan servicer, they're not going to remove that debt obligation. The only way you can remove that debt obligation is if you refinance or if you sell that property or if you just pay it off free and clear. So it's going to be basically the only way. So, say that, I use me for example, maybe I got divorced, spouse wins the house, and I need to move. I'm going to move somewhere near my work, which is, I didn't get a new job, and I want to go get another FHA loan, and I already have an FHA loan on my credit report. If that's specifically on the divorce decree that my spouse won the house, that's a contextual thing, essentially, where I could get the house. That's kind of a very special stipulation that that's a possibility that can get a second FHA loan. The second way, again, which this comes down to context, is, again, you have to think life challenges that basically it seems like that's very unfair that person's unable to get a second FHA loan. So things in context where FHA has remorses, like say it's a growing family. Maybe I bought my first house when I was 25 years old and it's a tiny, just 1 or 2 bedroom house. And then I have like 4 kids. And now I've got a growing family and I'm just crowded in this house and I want to go buy another house. Again, that's context, and they know, man, like he can prove that his current house just isn't going to be able to really accommodate his growing family. He wasn't aware of that. Now he's 35 and has 4 kids, or he's 25. He just wasn't aware that he was going to have that. That's a just new thing that has surfaced after the fact, after he closed on his property. That again, with that structured confidently and basically running that by the loan officer and the lender and the underwriter in context, that you should be able to allow someone to get 2 FHA loans. But as a good rule of thumb is you typically can't have 2 FHA loans. And again, to recap, the 100-mile rule just really applies for using rental income, whether the property trying to be rented out is FHA or not. Doesn't matter as long as you're buying it as an FHA, that applies. And then again, trying to get a second FHA loan when both properties are within 100 miles from each other. I hope this helps. And if you have any questions, you can find me on my website, mortgagemario.com. Have a wonderful day.